There are some green shoots, but we foresee 2020 to be more a year of growth consolidation than a full-fledged recovery. We forecast global growth of 3.1% in 2020, similar to that in 2019, built on 4 factors. One is a truce rather than an escalation in US-China economic frictions. 2, a turn in the global tech cycle. 3, looser macro policies. And 4, a depreciation of the US dollar. But a cautionary tale running through our outlook is how foggy it is, and to appreciate the downside risks. Hence the title of this report, Shaky Foundations. One risk to our baseline is the US-China Cold War escalates as economic and policy frictions feed off each other. Another is China's continued growth slowdown. And what makes this more challenging is our view that it will be domestic-led and that China has a narrowing room for policy responses. There are other tail risks, but the one that could turn out to be the greatest of all is the danger of a private sector credit crunch. Our baseline envisages modestly more global monetary and fiscal stimulus next year, but it may turn out to be a watershed year for restyling macro policies. The monetary policy reviews by the Fed and the ECB could result in both doubling down on running their economies hotter than before by strictly enforcing the symmetry of their inflation targets or moving to targeting average inflation over time. Alternatively, if it becomes plain that the costs and risks of negative interest rates exceed the benefits, 2020 could be a watershed in a very different way, with fiscal policies taking over from monetary policies as the main tool of global stimulus. Now, in this report, some of our high conviction views for 2020 include, firstly, global inflation staying subdued and the Fed, ECB and BOJ not raising rates in 2020 or 2021. And if recession risks resurface, the Fed is likely to respond quickly and aggressively in cutting rates. Fiscal expansion in Germany is unlikely to be excessive before the 2021 elections. France will become the new engine of growth in the Eurozone, and the ECB will cut rates in March 2020. China's slowdown will continue. In 2020, we forecast China GDP growth of 5.7%, led more by investment than exports, and policy easing will remain smaller than in past cycles. Japan's acceleration of GDP growth will be delayed until 2021, while India's GDP growth will disappoint the consensus, with it not rising back above 6% until the 4th quarter of next year. In Southeast Asia, we are below consensus in Thailand and above consensus in the Philippines, while in Indonesia, we caution that balance of payments vulnerabilities are rising again. Finally, the Reserve Bank of Australia. It's more likely than not to move to quantitative easing late in 2020.
The U.S. economy slowed last year, partly because fiscal stimulus wasn't providing as much support, but also because increased policy uncertainty was a drag on investment. The economy is currently growing at about 1.5% to 2%. We expect it to grow at roughly that level through next year, and then to accelerate as we transition into 2021. Policy uncertainty and its effect on investment are an important part of our outlook. Last year, increased uncertainty, particularly around trade, weighed on investment, and that was a big part of why the economy slowed. Looking ahead to next year, though, we think things will be a little better on that front. We think the likelihood of further escalation on trade disputes has gone down, and the US-China agreement creates the possibility that things could actually get better. However, the election creates other sources of uncertainty. First of all, the outcome is uncertain. Moreover, the Democratic Party has moved away from market-friendly policies. And so we think politics is going to provide some additional uncertainty next year, and that will have a negative effect on investment. Although investment's going to be a drag on growth, we think that consumer is actually going to be a source of strength. Income growth is strong, consumer sentiment is positive, and household balance sheets remain very strong. All of that means we think consumption is going to be a source of strength for the economy going forward. We expect inflation to pick up a little bit this year. That reflects the fact that we expect the dollar to depreciate somewhat, and that'll put some upward pressure on import prices. But also, very tight labor markets should push up wages, and that should push up inflation a bit. But overall, the Phillips curve remains quite flat, and we think this increase in inflation is going to be very moderate. Now, turning to monetary policy, the Fed cut interest rates by 75 basis points over the last 6 months. That's going to provide an important support for the economy going forward. We think the Fed is actually going to be on hold with respect to interest rates through this year and next. Now, that extended period of being on hold really reflects the fact that the Fed is very concerned about the fact that inflation has been below their target really for the last 10 years. And as a consequence of their strategic review of their inflation framework, we think they're going to be on hold for a long time. That's an important aspect of our outlook for monetary policy. Now, there's one important source of risk in our outlook, and that's the recent rise in corporate borrowing. We've seen a substantial increase in corporate debt over the last 5 years or so. Moreover, we've seen a deterioration in underwriting standards. That deterioration in underwriting standards is a pretty robust indicator of problems ahead. And we certainly think that if the economy slows substantially, we'll see a rise in corporate defaults. Having said that, I think there are reasons not to be overly concerned about this. First of all, interest rates remain very low, and therefore corporate debt burdens remain low. In addition, if you actually look at where the borrowing has taken place, a substantial part of the increase in borrowing has come with firms that start out with relatively low levels of leverage. The distribution of leverage across the corporate sector has actually become more even, and I think that's a reason not to be overly concerned. Overall, we maintain a pretty positive outlook for the U.S. economy going forward.
We believe China still faces strong growth headwinds from worsening fiscal situation, a cooling property sector, weakening exports, and the continued construction machinery slowdown. This should more than offset the likely boost from home completion, home appliance, and low base for autos, and perhaps 5G investment. We expect real GDP growth rate to slow from 6% year-over-year in the Q3 this year to 5.8% in the Q4, and then to 5.7% next year. CPI inflation may peak in January 2020 and remain elevated above 4% year-over-year in the first half next year, and higher pork price inflation will be a risk. We expect the Chinese government to ramp up its policy stimulus in 2020, despite a more limited policy room, and ease some tightening measures on the property market by spring next year. We believe market-based reforms are key to boost the long-run potential growth rate in China.
So in the Eurozone, we think that growth has bottomed. We think it's slowly going to recover from its 0.2% quarterly growth rate at the end of 2019 all the way through 2020. However, we don't expect growth to get back to elevated levels. We're talking only 0.3 or 0.4, which is about 1.5% annualized, maybe even less than that, which is below what the European Central Bank believes is the trend rate of GDP. Of course, the ECB is an inflation-targeting central bank, and it will be looking very closely at the evolution of CPI. CPI is currently running at very low 1 to 1.5%. We think that will recover, but it's going to take some time. Even most forecasters, the ECB, consensus forecasters, think that inflation is going to recover very slowly, and they don't really see it going past 1.5%. Now, for some members of the European Central Bank Governing Council, 1.5% is actually consistent with meeting the current inflation aim of the central bank, namely that inflation should be below but close to 2%. For others, it's quite a way off. And we think that what the ECB needs to do in its strategic review, which was announced at the end of 2019, we think they really need to look at changing the inflation target so that it is 2% identically. And that would mean that you have improved inflation expectations, but also more importantly, it means that the European Central Bank and its members there'll be very little room for interpretation of what that central bank target means. In other words, they need to achieve a very precise aim. When it comes to central banks, the Bank of England, we think that they may well cut interest rates early in 2020, but the window of opportunity for cutting interest rates is quite limited. The reason for that is because we think that there's going to be continued weakness in the economic data, inflation's going to fall, and that will give them a bit of room to loosen monetary policy by cutting interest rates by 1/4 point early on in 2020. However, given that our view is for a recovery, and that's based on a number of reasons, we have things like fiscal policy support, we've got uncertainty dissipating after the results of the general election, which of course the Tories won very conclusively, but giving way to perhaps a little bit more uncertainty towards the end of 2020. And that's largely based on the fact that that's when the transition phase of the deal with the European Union ends. And of course, there's a lot of uncertainty then about what sort of free trade deal, if any, Mr. Johnson will be able to agree with his European partners. So we see the Bank of England loosening policy, but then going back towards a gradual and limited increase in interest rates over the longer term. We think growth will recover slowly, and we think inflation is actually going to fall. And this is one of the reasons why we think that there is some opportunity for the bank to cut, because it thinks that by the end of 2020, we could see inflation moving as low as just 1.1% on a quarterly basis, which means that there is a real chance that inflation goes below 1%, requiring an open letter to be written by the Bank of England to explain why they've missed that target. So, in short, we have growth recovering across Europe. We have inflation rising eventually back towards its target, more so in the UK than in the Eurozone, but a period of much weaker inflation in the UK to come. And in terms of the central bank responses, again, very similar. We think that both central banks, the ECB and the Bank of England, will lower interest rates early on in 2020, but the Bank of England will come back towards hiking interest rates quicker than the ECB does, which is clearly a long way off before we even think about normalization in Europe.
My sense is that the cyclical viewpoint, the Japanese economy has almost ended its slowdown phase, while there are several structural issues that could be a downside risk to the economy. On balance of those things, we are currently expecting that the very steady but slow growth for Japanese economy to roll on up until the end of 2020. While the risk from the inside, like shock of consumption tax hike, yes, that could be a downside risk for the economic growth trend. But thanks to the structurally tightened labor market, mainly caused by the demographic trend, the income condition for Japanese ordinary household is very much favorable. So in a sense, I don't think that the consumption tax hike shock could be a major risk for the Japanese economic growth in next year. The Japanese government is taking measures in a very comprehensive way, I should say, and in many fronts. Not only in terms of, say, supporting consumption, but also to boost investment by making additional public infrastructure spending. So while the Japanese economy still experience the relatively slower growth pace, I should say that this kind of, say, policy support will be definitely needed. And that's what the Japanese government is trying to address.
What does 2020 hold in store for Asia? We don't see green shoots yet. We see a U-shaped rather than a V-shaped growth profile. We expect a further slowdown in Q4 with a prolonged bottoming out thereafter into Q1 due to weaker China, slowing G3, elevated inventories, and consumer slowdown in open economies. The first signs of recovery in our view are only likely in the second quarter as the region benefits from the tech cycle upturn and easier financial conditions. We see exporters leading the upturn while consumers lag. Inflation is generally likely to stay benign, but do watch out for upside risks from supply-side shocks like food inflation in India and China. On policies, the rate-cutting cycle is in late stages, but it is not over yet. And in case of a deeper slowdown, we think fiscal policies will be stepped up in the region. Compared to consensus, we expect growth to surprise positively in Philippines, but we are below consensus on India and Thailand. We believe that Indonesia could see balance of payment vulnerabilities. Overall, Asia's glass is half full and half empty. On India, we are negative on the growth outlook due to continued strains from the shadow banking crisis. We don't think the economy has bottomed out yet, and we expect a further slowdown in fourth quarter with 2020 growth at a subpar 5.5% below consensus. Inflation is set to rise in the near term because of supply shocks, but this stagflation type scenario is likely transitory. Weak growth will result in both fiscal risk materializing and credit risk remaining elevated, in our view. Monetary policy is currently hamstrung due to high inflation, but we do expect another rate cut in the second quarter when inflation subsides. Overall, we would argue that India needs a higher risk premium given its weaker growth and rising fiscal risks.